So cash flow statement, before we start, understand comprised of three types of cash flows. One is cash flow from operating, cash flow from investing, and cash flow from financing. What is operating? Operating means your cash from your daily operating activities. Okay? Which means nothing but your revenue, your costs, your income statement, whatever you have in your income statement, all of that will be a part of your operating. Clear? Cash flow from investing, as the name suggests, investing means the cash flows from investing. Where will you invest in? Which assets? Land. Good. So when I say investing in nothing but cash flow from investing in my non-current assets. Because those are my investments. I'm not talking about share capital, okay? Shares also. So here I'll talk about maybe PP, and also I'll talk about my equity investments, my debt investments I taught you in the earlier part of the lecture. All this is my investing activities. Whatever money I invested, outflow, I sold, inflow. Clear? What is cash from financing activities? From all your financing means loans, liabilities, share capital, all that. So here I'll take care of all my loans, which is my non-current liabilities, and shareholders' funds, which is my equity. All the movement from financing, even interest, expense, will come here. Here. So investing is non-current assets, financing is non-current liabilities, right? And equity, right? Now you guys tell me, non-current assets came here, non-current liabilities came here, equity also came here. Where are my current assets and current liabilities? Where will that go? CFO. CFO will take care of my current assets, current liabilities, and my entire income. So I hope you realize CA comes here, NCA comes here, CL comes here, NCL comes here. Equity already comes here, and the entire income statement will come here. That's how cash flows are made. I take care of every line in the income statement and balance sheet and give you cash flow. So I hope you realize every line is covered. There's no line that's been left out. Clear? Make a quick note of this because these are the components and the source. CFO, CFI, and CFF.
Sir, I have one question.
Yeah.
Yes, sir. When we are preparing the investment, and the financing one, so like in all the cases, we take from either income statement or balance sheet the changes aspect, even for the current assets or the current liabilities. So suppose we are doing it for from annual report, if we are taking the consolidated statements, and if you're trying to first put that audited period amount in the cash flow statements, and so that in the after that we can forecast for the forecasted years. So if we are doing in that way, so for the first year of the audited period, how we will take the amount, like just the same amount along with their like sign, if they are like increase or decrease, depends on the nature or changes amount.
So in the first period, there is no concept of change. Whatever is the amount, you will have to say that's an increase. There's no decrease only, right? Because everything started from 0 to something. So the first period will always have a plus. There won't be a negative sign in the first period.
I mean, sir, the exact amount from the balance sheet example, suppose we are looking for cash, current assets or the current liability amount.
Correct.
So exact amount we will take, or the changes like from the current year minus last year, that way the way we do.
You always take the changes because your cash flow nothing but the change. Example, if your building was 100 and next year it became 130 because you purchased building of 30. So the change of 30 is your cash flow, right? Last year 100, additions 30, it became 130. So what is the cash flow? 30. It's an outflow. So you'll always take the change in the balance sheet. In the income statement, you'll take the full income statement because income statement is for the year, but balance sheet is as at the year end. Got it? So income statement you take for the year, full amount, and balance sheet you'll take the change opening minus closing. That change is going to be your cash flow amount. Got it?
Yes, got it.
Always change. So that was how I told you is cash flow statement. So if you look at the screen, there are three types of CFO which I already explained to you earlier. Operating, investing, financing. When I add all the three, I will get the total cash flows, the total change in cash flow, which is nothing but the opening cash minus closing cash. Here, but do understand one thing, it is not just cash, it is cash and cash equivalent, which is cash, bank, and FDs less than 3 months. All of this is cash and cash equivalent. Cash, bank, FDs. Clear? Are we clear with that? So remember, change in cash flow will give a better idea of what is the changes in all my cash and cash equivalent numbers. Okay. So let's look at the process. I'm just trying to see if I can give an example of these. So the girl who asked the question, you'll notice here now, I need to look at what is my total cash flow from various sources, right? So let's start with the first one, CFO. Now CFO, why do you think the income statement is not your cash flow? Your income statement effectively is not your cash flow, right? Any reason why? I can just say my income statement and say that's my cash flow for the year, right? There are two reasons why the income statement and cash flow from operating activities is not the same. Anyone?
Sir, it shows only profits. No, it also shows non-cash profits also. Income
Very
statement.
good. One answer. So one is the income statement shows non-cash also, but the cash flow I want only cash, right? And the second answer is in the income statement, you record revenue and cost based on what's principle? Accrual system or cash system?
In income statement, it's accrual, and in cash flow, it's cash based.
Very good. So guys, if you learn this well, you know the cash flow. There are two reasons why my income statement, right? I have an income statement. The income statement, I do various things and I come to a figure of PAT, right? What I do, revenue, my costs, my blah, blah, I get PAT. This PAT is my profits for the year. Is this my cash profit? No. This is my net income, net profits, not my cash profits. There are two reasons why this PAT is not cash. There are two reasons. One, I have also included depreciation, amortization. Basically, every non-cash has been considered, right? In my PAT, I have reduced expenses which are depreciation, but that's non-cash, so therefore don't tally. Second, I have recognized everything on an accrual basis. Means I have accrued income, though I didn't receive the cash. I have made the payment. No, I have recorded expense, but payment not made. Or maybe I made more payment, but record only less payment because I put in prepaid. So whatever cash flow happened is not recorded. Whatever expense incurred and revenue earned is recorded. So cash will never tally with income. You got the logic? So how to tally? Simple. Adjust these two items, you will get cash flow. If I want to convert PAT to cash, right? If this is my income, let's say I earn 200. But I wonder what's my cash income. Simple. Take 200, adjust this, you will get cash income. Right or wrong? Simple logic, right? And therefore the formula is starting point. What is my PAT? What is my non-cash charges? Depreciation, amortization added. And what is my accrual? Now, accrual means if I accrue something, the remaining is line assets or liabilities. If I sold goods, money not received, where is it line? Debtors. If I bought goods, I did not pay, where is line liabilities? So if I look at my working capital changes, right? That means if my debtor 100, if it became 60, that means I receive 40 today, cash. If it became 140, it means I paid him more 40. So if I make these changes and I consider those current assets current changes, I will get cash flow from operating activities. Do you agree or not? So how to convert PAT to cash? Take care of these two adjustments. One is non-cash, which is nothing but D and A, depreciation amortization, and the second is working capital changes. And that's your formula you need to master. Net income plus NCC plus working capital changes is called C. Very, very important. Make a note of this. So understand why it's differing and why the formula is that way.